The U.S. China Economic Game, the Federal Reserve's rate hikes and their linkage with Chinese financial markets. In the global economic landscape, the U.S. and China, as the world's two largest economies, often trigger chain reactions through their policy interactions. Since 2022, the Federal Reserve's rate hikes have redirected global capital flows, significantly impacting the Chinese economy. This analysis, based on historical events, explores why the Fed chose March 2022 as the starting point for its rate hikes and examines the subsequent economic dynamics between the U.S. and China. Through this lens, we can observe how the interplay of their policies influences financial market performance. 1. The timing of the Fed's rate hikes, balancing pandemic and inflation. The Federal Reserve's decision to raise interest rates was heavily influenced by domestic economic indicators and external factors. By the summer of 2021, the U.S. Core Consumer Price Index had begun to rise significantly, signaling emerging inflationary pressures. However, this period coincided with the peak of the Delta variant outbreak, which spread rapidly in mid-2021. Named by the World Health Organization in May 2021, the Delta variant became the dominant strain by summer, triggering new lockdowns and economic uncertainty. Under these conditions, the Fed could not immediately tighten monetary policy, as premature rate hikes risked undermining employment and consumption recovery. By the winter of 2021, the Omicron variant emerged. Discovered in late November 2021, it quickly became the dominant global strain, driving a surge in infections from late 2021 to early 2022. Although Omicron had a lower mortality rate, its high transmissibility exacerbated supply chain disruptions and labor shortages, further delaying the Fed's plans. Following the Omicron wave, the U.S. began to reopen. In March 2022, the White House announced a "Living with COVID" plan, lifting pandemic restrictions entirely. On the consumption front, despite a peak in infections in January 2022, U.S. personal consumption expenditure only dipped slightly and rebounded quickly as the pandemic stabilized. Consumption growth soon returned to pre-pandemic trends, demonstrating the resilience of the U.S. economy. The Biden administration shifted its focus from pandemic control to the U.S. China economic rivalry. On March 16, 2022, the Federal Open Market Committee raised the federal funds rate by 25 basis points, from near 0 to 0.25% to 0.50%, marking the first rate hike since 2018 to address persistent inflation. One immediate consequence of the rate hikes was a shift in global capital flows. Rising U.S. interest rates attracted international capital, putting pressure on emerging markets, including China, through capital outflows. After March 2022, Chinese stock markets accelerated their decline. The CSI 300 index fell from its pre-hike peak, with foreign capital outflows intensifying. Data shows that between March and April 2022, approximately $7 billion flowed out of Chinese equities, driving a market drop of over 20%. This was seen as a spillover effect of the Fed's rate hikes, exacerbating RMB exchange rate volatility and weakening market confidence in China. 2. The U.S. offensive, accelerated rate hikes and China's self-rescue. The Fed's rate hikes were not a one-off but escalated gradually, interpreted by some observers as an economic offensive against global competitors. On May 4, 2022, the Fed raised rates by 50 basis points, exceeding expectations and further boosting the dollar's appeal. Chinese stock markets briefly stabilized but remained under pressure. In May 2022, recognizing the risks of capital outflows and market turbulence, the Chinese government implemented self-rescue measures, including growth-stabilizing policies, increased infrastructure investment, and consumption stimulus. These measures led to a 20% rebound in the CSI 300 index. By July, the Fed's actions grew more aggressive. On July 27, 2022, it raised rates by 75 basis points, the third significant hike of the year. This rapid tightening widened the interest rate differential between the U.S. and China, with U.S. 10-year Treasury yield surpassing Chinese 10-year government bond yields, accelerating capital outflows from China. As a result, Chinese stocks plummeted. The CSI 300 index fell over 20% from its July high, and foreign capital outflows set a monthly record, exceeding $10 billion. Through monetary tightening, the U.S. not only curbed its own inflation but also indirectly weakened China's external financing environment, escalating economic pressure on China. 3. China's counterattack, post-Congress policy shift and U.S. internal challenges. Facing external pressures, China reached a turning point by late 2022. In October, the 20th National Congress of the Chinese Communist Party concluded, completing a leadership transition. Meanwhile, the U.S. neared its debt ceiling in October 2022, limiting its ability to attract capital through new treasury issuance. This provided China with a counterattack window. The Chinese government rolled out growth-stabilizing policies, boosted infrastructure investment, and optimized pandemic controls, achieving a rapid post-peak recovery. By late 2022, Chinese stock markets began to rebound, with roughly $40 billion in foreign capital inflows. In March 2023, the U.S. faced a banking crisis. Silicon Valley Bank, SVB, collapsed on March 10, triggering turmoil at Signature Bank and First Republic Bank. U.S. Treasury Secretary Janet Yellen and Fed Chair Jerome Powell swiftly intervened, injecting liquidity and guaranteeing deposits to avert a broader financial panic. Concurrently, the AI sector exploded. In November 2022, ChatGPT sparked a generative AI wave. By March 2023, OpenAI's GPT-4, with multimodal capabilities for text, images, and video, ranked in the top 10% on bar exam simulations and top 11% on SAT math tests. These advancements fueled applications like AI video generation and intelligent customer service, driving U.S. tech stock growth and boosting the Nasdaq index in the first half of 2023. 4. The U.S. renewed offensive, the Fiscal Responsibility Act and U.S. China Economic Dynamics. In June 2023, the U.S. passed the Fiscal Responsibility Act, a bipartisan compromise that suspended the federal debt ceiling until January 1, 2025, averting a potential global financial crisis. The act capped non-defense discretionary spending for fiscal years 2024 and 2025, reclaimed and used COVID relief funds, and expedited energy projects, stabilizing fiscal policy amid partisan gridlock. Economists had warned that a debt default could trigger a recession, millions of job losses, and a credit rating downgrade. The act eliminated this threat, clearing major economic uncertainties since early 2023. It injected new momentum into the U.S. economy. In Q3 2023, driven by robust consumer spending, business investment, and a strong labor market, U.S. GDP grew at an annualized rate of about 4.9%. Backed by economic stability, the Fed continued its aggressive rate hikes. By late 2023, the federal funds rate peaked at 5.25% to 5.50%. The U.S. economic recovery rippled globally, exerting pressure on emerging markets through a stronger dollar. Between 2023 and 2024, the dollar appreciated over 10% against a basket of major currencies, raising the cost of dollar-denominated debt and weakening export competitiveness in emerging economies. This intensified vulnerabilities in high-debt nations across Latin America, Southeast Asia, and Africa, leading to currency depreciation, tighter financial conditions, and slower growth. For China, grappling with a sluggish property sector, regulatory crackdowns, and a weak post-pandemic recovery, these external pressures compounded domestic challenges. Chinese stock markets bore the brunt, with the Shanghai Composite Index falling over 20% from mid-2023 to February 2024, hitting a multi-year low of around 2,635 points. In 2023 alone, foreign capital outflows exceeded $80 billion, driven by concerns over geopolitical tensions, China's slowing GDP growth, 5.2% in 2023, and RMB depreciation against a strong dollar. Broader indices like the CSI 300 and Hang Seng also faced pressure, with Chinese offshore stocks declining nearly 15% in 2023. This marked a three-year downturn since the 2021 peak, evaporating trillions in market value. This market turmoil reflected both cyclical pressures and structural issues, such as the over-leveraged property sector, e.g. Evergrande, and a shift in investor sentiment toward safer assets. Analysts interpreted these developments as a U.S. renewed offensive against China, leveraging the dollar's dominance and technological advantages. The strong dollar amplified the impact of U.S. export controls on advanced semiconductors and AI technologies, limiting Chinese access to critical innovations and forcing supply chain diversification. U.S.-China trade tensions escalated in 2023, with tariffs, investment reviews, and de-risking strategies reducing bilateral trade. Mexico overtook China as the U.S.'s largest import source, signaling a broader trend toward economic decoupling. Through policies like the CHIPS and Science Act and Inflation Reduction Act, the U.S. bolstered domestic manufacturing while pressuring China's growth model, potentially reshaping global supply chains and power dynamics in the coming years. 5. Conclusion: a forgotten financial battle and future prospects. Remarkably, no prominent media, scholars, or journalists today discuss the U.S.-China financial battle that unfolded 3 years ago. The world underestimated Joe Biden, Janet Yellen, and Jerome Powell, who came close to defeating China and making America great again. While China withstood the U.S. offensive, it suffered significant losses. The U.S. also paid a heavy price, with its national debt rising by trillions. By 2024, realizing a financial war could not defeat China, Biden sought negotiations with Xi Jinping for a new agreement, but his failure to secure re-election halted this effort. Looking ahead, with the rise of AI and increasing global economic complexity, the U.S.-China rivalry may enter a new phase.